Hello, and welcome to this special podcast from the Eye of the Needle podcast team at Columbia Threadneedle Investments. I'm Mark King, Head of Content for EMEA. In this episode, we're going to hear the thoughts of two of our leading investment professionals, Nadia Grant, Head of US Equities, and Toby Nangle, Global Head of Asset Allocation. Both have recorded audio from their homes as we continue to navigate our way through the current Covid-19 crisis and its impacts. Clearly, the crisis is affecting all our lives, from our health to our schools and the wider economy. For investors, the situation is extremely complex too, with impacts being felt by companies in every sector. Global supply chains are also subject to huge disruption. Both Toby and Nadia are going to talk about how markets are reacting to the ongoing situation and the impacts for their asset class and positioning. First up is Toby Nangle, who will talk to us about how the world of multi-asset investing has been affected by Covid-19 and how he's responding from an asset allocation point of view.
The collapse in stock markets and credit markets seen in March was pretty tough to manage through, but at least everyone seemed to understand what was happening. I mean, the whole world was being shut down. It was being put into a protective coma of unknown duration in an effort to save human life. And all of us non-key workers were sent home to either work or be furloughed or were sacked. So looking back, it's not a huge surprise to find that financial markets utterly freaked out. Yeah, freaked out, I guess is a technical term here. Still, in those early days of lockdown, there was widespread hope that things might bounce back quickly. So if a firm had enough cash on hand and low enough fixed costs, investors could see that they'd pull through. And this severe economic slowdown, or maybe shutdown, be a better description, would be transient. But as time's ticked on, our expectation of the economic rebound has evolved, and it's evolved for the worse. So we were looking for a U-shaped recovery with a risk to a quicker upturn. But since March, that's been shifting to an expectation of a U-shaped recovery and a sizable risk to a much, much longer recovery. So this is this so-called L-shaped recovery. And yet, during this period, stock markets have rallied and credit spreads have fallen. And we've been buyers. So what's been going on? Well, a big part of the answer for us has been monetary and fiscal policy. By our reckoning, most of the sell-off in credit markets was associated with the utter chaos and illiquidity of the market just freaking out. And this credit market freeze rippled through stock market valuations. So when central banks came and said, we're just not going to sit by and watch the whole financial system simply burn down. Oh, and yeah, by the way, we're monetary sovereigns and we have pretty much unlimited power in the monetary realm. That was a signal to us that some of the falls in asset prices that were directly associated with illiquidity might reverse. It sounds easy now to say that things got a bit mental and there were dollar bills lying on the ground for us to pick up, but it felt pretty bold at the time to be buying risky assets as the world shut down. What risky assets did we buy? Well, the highest quality ones. This has meant investment grade credit, high quality global equities with strong balance sheets, strong cash flows, competitive moats. This would sound like a defensive move where the funding for these purchases are not coming from cash and from government bonds. So the message from us has been to get on board a greater quantity of higher quality risky assets. And that's how we've been building our portfolios.
Toby Nangle, Global Head of Asset Allocation there. And now it's time to hear from Nadia Grant, Head of US Equities. The US stock market, of course, includes the S&P 500 index, home to huge corporate entities such as Facebook and Amazon. And Nadia's going to talk to us about a consistent approach in uncharted territory. Over to you, Nadia.
We'll first cover how the US Equities team, based in London, has adjusted to the challenges posed by the lockdown. We'll then review the market backdrop and end our discussion with our economic and market outlook. So how has the team adjusted? Transition to working from home has been seamless. Client services continues uninterrupted. Support from risk, compliance, trading team continues as normal. We continue to have excellent access to management teams through video calls, conferences. Liquidity has been good, not having any issues getting our trades away. The US equity market is indeed very deep and liquid. Flows have been manageable and several sophisticated investors have been topping up through the sell-off. Now, our active approach finding opportunities in volatile markets has enabled us to stay focused on our investment process. This consistency in our approach has served clients well during this period, with a strong Q1 performance across the US desk. Let's now turn to the market. The coronavirus pandemic caused the S&P 500 to correct steeply and at the fastest pace to peak to trough on record, declining about 35% in a month. This may be explained in part by the structure of the market dominated by ETF, and of course, by the very unprecedented nature of this exogenous shock. However, from the lows of March 23rd, the market has recovered over 2/3 of its loss, with three fundamental drivers: the swift and massive fiscal and monetary action. From a healthcare standpoint, signs that new cases were peaking in Europe and in the US, and more recently, hope that a vaccine might be available as early as year-end, 1 year earlier than previously thought. And on the economic front, a gradual easing of the lockdown with a few states reopening. Since the end of March low, there's been several tentative style leadership rotation in favor of value and away from the dominating quality and growth name. While much uncertainty remains, we note that valuation spreads are indeed at extremes. As a result, some value names on our watch list look very compelling. Given this backdrop, what are our economic and market outlook for the year ahead? The consensus of economists on the sell side expect US GDP to decline 6 to 8% in 2020, with an H2 recovery and a deep trough in Q2. We think the S&P 500 is likely to decline over 30% in 2020, with a much wider confidence interval than usual given the highly unstable economic backdrop. With Q1 earnings down nearly 15% and Q2 on track to decline more than 40%, estimates of large variances, as many companies have given up providing any form of guidance. Energy is expected to lead the earnings decline amid plummeting oil demand, with consumer discretionary, industrials and financial also pulling down the average. Indeed, the OPEC Plus fiasco, as well as lockdown-related demand collapse, has taken 25% of global oil demand off the table, leaving energy profits in tatters and the industry in proper distress. Consumer discretionary sector is getting hit by plunging employment, as well as social distancing complications for many leisure activity. Financials are hurting from deteriorating credit, driving massive reserve and provisioning, and record low interest rate driven by the monetary stimulus to combat the virus. On a brighter note, turning to the leading sectors, some will see their earnings being flat to just slightly down this year. Namely, those enabling social distancing and working from home within tech and consumer services, those providing day-to-day necessity such as utilities and consumer staples, or indeed help solve the crises in the healthcare sector. In conclusion, unlike 2008, this is a medical emergency which will be resolved with a medical solution. We note that there are imminent trials readout on therapeutics, as well as vaccine trials well on the way. The pandemic constitutes an exogenous shock, provoking short-term dislocation. The US economy was strong prior to the disruption, but the magnitude of the fall in sales and profit will be substantial. We expect activity to resume in time, but we have little visibility over the recovery's shape or pace. There will be undoubtedly long-term consequences to this crisis, impacting companies in sector. For example, the acceleration of adoption of telemedicine and working from home, or a rethink of pricing real estate for office space, the implication of the accelerated adoption of video calls on business travel, and many more. Therefore, a consistent, active approach is key to navigating this uncharted territory.
Many thanks to Nadia Grant there and Toby Nangle for giving us their thoughts on the ongoing impacts of the Covid-19 crisis. We'll be back very soon with another podcast, and in the meantime, if you do have any feedback for us, email podcast@columbiathreadneedle.com. See you soon.
Important information. Your capital is at risk. Past performance is not a guide to future performance. The analysis included in this podcast has been produced by Columbia Threadneedle Investments for its own investment management activities. Information obtained from external sources is believed to be reliable, but its accuracy or completeness cannot be guaranteed. None of Columbia Threadneedle Investments, its directors, officers or employees make any representation, warranty, guarantee or other assurance that any of these forward-looking statements will prove to be accurate. The mention of any specific shares or bonds should not be taken as a recommendation to deal. This podcast is not investment, legal, tax or accounting advice. Investors should consult with their own professional advisors for any advice. Issued by Threadneedle Asset Management Limited, registered in England and Wales, number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG. Authorised and regulated in the UK by the Financial Conduct Authority. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies.